Imagine you walk into your bank tomorrow morning. You walk past the teller, past the loan officers in their cheap suits, and you demand to see your money. Not a number on a screen, not a paper receipt. You want to see the physical cash. The pile of cotton and linen paper that represents the years of your life you traded away for labor. You check your app. It says you have $10,000. You assume that somewhere in the back, inside that reinforced steel room, there is a box with your name on it containing $10,000. You are wrong. If you have $10,000 in your savings account, the bank is likely holding less than $100 of it. The rest isn't in the vault. It isn't in the ATM. It isn't even in the building. The money you think you have is nothing more than a hallucination, a collective dream shared by you, the bank, and the government. And the terrifying part isn't that the money is missing. The terrifying part is that the entire global economy relies on the fact that you never ask for it. We need to start by understanding what a bank account actually is. We are taught to think of it like a digital piggy bank. You put money in for safekeeping, and you take it out when you need it. But legally, that is not what happens. And the legal reality is much darker than you think. When you deposit $1,000, you are not storing money. You are lending it. You are technically an unsecured creditor to the bank. That deposit is now their property, not yours. In exchange, they give you an IOU. That's what your bank balance is. It is not a count of assets. It is a record of debt. The bank promises to pay you back that debt on demand. But here is the catch. They promise to pay everyone back on demand while simultaneously knowing that if everyone asked at once, they would be insolvent within hours. This is not a glitch. This is the design. It is called fractional reserve banking, though in the modern era, even that term is becoming outdated. We should call it what it really is, the confidence game. To understand how we got here, we have to go back to 17th century London. Before digital ledgers, there were goldsmiths. People had gold. Gold is heavy, dangerous to carry, and easy to steal. So, people paid goldsmiths to store their gold in secure vaults. The goldsmith would give them a paper receipt. Soon, people stopped bothering to go get the gold. They just started trading the receipts. It was easier. The paper became money. But the goldsmiths noticed something. On any given day, only about 10% of the people came to claim their actual gold. The other 90% of the gold just sat there gathering dust. Greed is the mother of innovation. The goldsmiths realized they could issue receipts for gold they didn't have. If they had 100 ounces of gold in the vault, they could print receipts for 1,000 ounces and lend them out to earn interest. As long as everyone didn't come back for their gold at the exact same time, no one would know the difference. They created money out of thin air, backed by nothing but the assumption of silence. Fast forward to today. The goldsmiths are now multinational banks. The gold is gone, and the receipts are now database entries. But the mechanic is exactly the same. In fact, it has become even more aggressive. Most people believe that banks lend out the money that other people deposit. Granny deposits her savings, and the bank lends it to you to buy a house. That is a lie. That is the fairy tale they tell, in Economics 101. Textbooks. In the real world, banks do not lend out existing money. Banks create new money when they issue a loan. When you go to get a mortgage for $500,000, the bank does not check to see if it has $500,000 in the vault. It does not move money from another account into yours. It simply types the number 500,000 into your account. In that instant, new money is born. It didn't exist 5 seconds ago. It was summoned into existence by your signature on a loan document. This brings us to the uncomfortable math. In most modern economies, physical cash, the coins and notes printed by the government, makes up only about 3 to 8% of the total money supply. The other 97%? It's commercial bank money. It's just credit. It's digital numbers created by private banks when they make loans. Think about what that means. 97% of the money in existence is temporary. It is someone else's debt. If every debt in the world were paid off tomorrow, if everyone paid their mortgage, their car loan, their credit card, our money supply would vanish. There would be almost no money left in circulation. The system requires constant debt expansion just to stay alive. It is a shark that must keep swimming, or it drowns. But here is where it gets dangerous for you specifically. Because you are an unsecured creditor, you are last in line if the bank fails. And for small amounts, they do. But what happens if the crisis is too big for the insurance fund? Following the 2008 financial crisis, laws changed globally. In the US, the UK, and Europe, new legislation introduced a concept called the bail-in. We all know what a bailout. That's when the government prints money to save the bank. But a bail-in is different. A bail-in allows a failing bank to legally confiscate the deposits of its customers to recapitalize itself. They take your money, the money you thought was safe, and they turn it into bank stock. Worthless stock in a failing company. This isn't theoretical. It happened in Cyprus in 2013. People went to sleep with savings and woke up with bank shares they couldn't sell. The money in their accounts simply ceased to exist because the bank needed it more than they did. This is the danger of keeping your wealth in a system where you don't own the underlying asset. You don't own the money. You own a claim on the money, and claims can be rewritten. But you might be thinking, so what? I can still spend the digits. The bartender accepts the digits. The landlord accepts the digits. You should care. Liquidity is the illusion that you can convert your digital claim into real value whenever you want. The bank bets on probability. They bet that on Tuesday, only 5% of you will need cash. But what happens when fear enters the equation? A bank run. It doesn't happen often, but when it does, it reveals the lie instantly. When Silicon Valley Bank collapsed in 2023, it didn't collapse because they had no assets. It collapsed because their customers tried to withdraw $42 billion in a single day. The bank didn't have $42 billion. No bank has the money they owe you. Not JP Morgan, not Bank of America, not your local credit union. In the digital age, a bank run doesn't look like a line of people around the block. It looks like a server crash. It looks like a transaction declined notification. It happens at the speed of light. Have you noticed how difficult it is becoming to use physical money? Branches are closing. ATMs are disappearing. Limits on cash withdrawals are getting tighter. They tell you this is for convenience. They tell you it is to stop criminals. But there is a darker reason. Physical cash is the only form of money that exists outside the digital ledger. It is the only form of money you can hold in your hand without a third party's permission. You cannot be negatively impacted by a server crash. You cannot be locked out of your account. By slowly eliminating cash, the system forces you to stay inside the digital casino. They are removing the exit doors. They want 100% of the money supply to be digital. Because if you can't withdraw your money to cash, a bank run becomes impossible. You can only move money from Bank A to Bank B, but you can never leave the system entirely. And this leads us to the final evolution of the money doesn't exist problem. The central bank digital currency, CBDCs. Governments around the world are currently building a new form of money. Unlike the digital dollars in your bank account today, which are liabilities of a private bank, CBDCs are direct liabilities of the state. They are programmable money. If money is just code, then the people who write the code can control how you spend it. Imagine money that has an expiration date to force you to spend during a recession. Imagine money that cannot be used to buy certain items because you've exceeded your carbon footprint for the month. In this future, money doesn't just not exist in a physical sense. It ceases to be your private property entirely. It becomes a government voucher system. But let's step back to the present day. When the illusion breaks right now, who fixes it? The central bank. When private banks run out of money because they played the leverage game too hard, the central bank steps in and prints the difference. They flood the system with liquidity to make sure the ATMs keep working. But there is no such thing as a free lunch. When they print money to save the banks, they dilute the value of the money in your pocket. This is the hidden tax. The reason your bank account exists is that the government guarantees it. But the cost of that guarantee is the slow, invisible erosion of your purchasing power. They save the number on your screen, but they destroy what that number can actually buy. So, does your money exist? In a physical sense, no. In a legal sense, it's an IOU that can be rewritten. In a practical sense, it works only as long as we all agree to pretend. We live in a faith-based economy. The dollars, the euros, the yen, they are not backed by gold. They are backed by faith in the state, and faith that the banking system won't turn off the servers. This isn't a conspiracy theory. It is the operating manual of the modern world. The next time you log into your banking app and see that number, remember what you are looking at. You aren't looking at a vault. You aren't looking at a pile of assets. You are looking at a score in a game that creates winners and losers. And the first rule of the game is simple. Don't try to cash out, because there is nothing there to cash out to.